The session title for our next session is The Role of RNS in Financial Crises and the Fed's Role as Lender of Last Resort. And we have a great panel discussion with some current and former Fed people here up on the podium to help us cover that topic. So let me introduce myself. I'm Mike Gibson. I'm the director of the Division of Supervision and Regulation here at the board. And before that, I was in the Division of Research and Statistics for many years, I guess maybe 13 years. And before that, I actually started in the Division of International Finance, so I'm on my third division here at the Fed. And over my career, spanned a bunch of different things, which we'll get into. I'll talk about a little bit of that when we get into the session. Let me introduce our other panelists. Sitting next to me, Don Kohn from the Brookings Institution. Are you going to introduce yourself? I didn't have an introduction for you. It's in the book. A lot of important roles here at the Fed, Bank of England, other places. Then going down, Andreas Leonard, currently the director of the Division of Financial Stability, but also a alum of the RNS division, and then at the end, Pat Parkinson. My predecessor is director of the Division of Supervision and Regulation. Before that, longtime officer in the Division of Research and Statistics, and another person who started in the Division of International Finance. So we've got a great range of experiences up here, and I know we're all looking forward to talking about a few, I would say, stories about our time in RNS and things related to the topic of the session around financial crises, the Fed's role as lender of last resort, things that we've all worked on to a greater or lesser extent. So just to let everyone know how the session's going to run, I'm going to give a few of my own opening remarks, and then we'll let each of the other panelists do that as well. We're just going to touch on our time in RNS and various roles we've had over our careers related to the topic of the session. Then we've got some Q&A. I've got some questions that I'm going to pose to the panelists, and then at the end we will have time for your questions. So please be thinking about what questions you might like to ask the distinguished panelists. And then lunch is at 12:15, and we won't. I commit right now that we will not run over, and we will finish on time so that we have time to get to lunch on time. So with that, I'll start with my opening remarks, and then we'll turn it over to the rest of the panel as well. So I guess one of the things that I reflected on when I was thinking about the topic of the session and the role of RNS in fighting financial crises, and of course that's one of the Fed's important functions, is to handle crises that crop up, and both on the central bank side of the Fed as well as bank supervision and the other roles of the Fed. One of the things that the country looks to the Fed is to be that crisis firefighter. And I would say one of the things in my experience when I was in RNS related to that is that financial crises really bring out, in some ways, the best of the Fed, and in particular, the collaboration that happens across the Fed. So, everyone has their own individual job and their own individual responsibilities, but in times of a financial crisis, that's really where the collaboration comes to the fore. So, people in research, working with people in supervision, working with, now we have the Division of Financial Stability, and the collaboration that we all have built up, and we work together. That's one of the rewarding parts of that type of work, but it's also one of the things that makes that sort of work effective in my experience, is we have that good collaborative spirit and culture here at the Fed, not just from research and statistics, but working with the other divisions. Within RNS, as I'm sure you all know, very well. There's a lot of different functions. There's the financial sections, there's the non-financial sections, and one of the things that I recall from my time in RNS is that, of course, there's a lot of focus on the FOMC. Of course, there's a lot of focus on monetary policy, and that cycle plays a big role in the work here at the Fed. But there's a lot of things that RNS does beyond just support the FOMC. And when we get into the talking about fighting financial crises, that's when it really involves the whole of RNS and really the whole of the Fed in doing that. I certainly recall everyone pitching in the 2008 financial crisis. Seems like the Fed was responding to one event after another, creating new programs, creating new lending facilities, doing that stress test that had never been done before, doing that TALF program. And one of the things that my work in RNS leading up to the 2008 crisis, working closely with Pat and also with Don, we had done a lot of collaborative projects both across the Fed and with other agencies and also internationally on financial risks, things that are now called financial stability, but didn't really have that much of a focus back then. And my experience working in RNS was that those sorts of collaborative projects were really good experience and really good preparation for when we did have a financial crisis. We had built some experience, we had built some relationships through the work that RNS had done, people in RNS had done with other agencies, with people at Treasury, with people at our international counterparts. So the work that we're doing in quote unquote normal times did turn out to be good preparation for the work that we had to do during the crisis. And again, that collaboration that I talked about was really valuable. Another thing I thought about related to the topic of this session is that one of the things I feel like I was able to do and people from RNS generally are able to do in these situations is bring an economist's perspective and also an economic research perspective to these financial crises and the other topics that we're talking about, because a lot of times it's a very multidisciplinary environment, and the other parts of the Fed, like supervision and regulation where I work now, we do have some economists that work in supervision and regulation, but certainly RNS and the other economics divisions are very economist-centric, and that is a strength that we then bring to some of these other projects, and in particular in a crisis when it's sort of a firefighting mode, sometimes you're just thrown into it, and having the Fed training and the Fed economist experience, at least for me, I found that to be helpful in one place where I could add some value. And I guess the last thing I will say before I turn it over to the panelists to give their introductory remarks is that, as I said at the beginning, I'm on my third division at the Fed, and I feel like being open to changing jobs and being open to even changing divisions has been something that's been good for me personally. I've enjoyed getting to do different things. It's given me good experiences and diverse experiences that I've been able to bring to new roles, and I feel like as we grow our future leaders here at the Fed, it's a good thing to keep in mind to give people those broad experiences, give people exposure to different types of projects. That's been helpful for me, and I feel like as we're building our skills and our leadership to handle whatever comes at the Fed in the future, having that sort of a training ground where people can learn and then deploy what they learn on some pretty interesting and important topics. I think that's valuable. It's been valuable for me personally. I think it can be valuable for us as an organization, so that's also something I like to talk about. Okay, so that's my opening remarks, and we'll just go down the line, and I'll let Don Kohn go next.
Thanks, Mike, and I appreciate the opportunity to be here and see so many old friends. I think, actually, I want to pick up on something you said about collaboration and how important it was. Boy, did that come home to me in the 2008, 2007, 8, 9 thing. And in particular, the collaboration between Sup and Reg, RNS, MA, and the board. So I was vice chair at the time. And I remember just one story, just doing the stress tests. We certainly worked with RNS, Dave Reifschneider, on the scenario and how to figure out what the 5% or whatever tail of the distribution was we were going to stress things to. And then we put RNS and Sup and Reg in charge of doing it, right? And I remember being encouraged every night. Nellie Lang and Corey Stephenson would come down to my office, joined at the hips with whatever the problem was of that day. But I remember thinking, if these people can work together so closely and bring the strength of those two divisions to bear on this thing, we just might have a chance of making this darn thing work. So I think that collaboration was absolutely essential to the success we had with the stress test, but also dealing with the whole crisis. We couldn't have made decisions about discount window lending without the supervision and regulation people telling us what they knew about these banks. Was there a business plan? Wasn't there? So it really strengthened the argument for keeping supervision inside the Federal Reserve, just for crisis management purposes. So that, I wasn't going to start that way, but I will, in my remarks, I want to say a few things. One is, as I started thinking about this, I spent a lot of my career in RNS and MA, even before getting to the board, dealing with financial crises. And in fact, on reflection, I came in summer of 1975. One of my first jobs in the fall of 1975 was to talk to the New York Fed and find out what rates the certificates of deposits, the negotiable CDs of the New York banks were trading at. So for the first time in 1975, when New York City was going under, the rates of the big New York City banks had all been the same, and then they started separating. And that separation of what banks were paying for what was an important input into the crisis management. And I took talked to the New York Fed every afternoon, took the piece of paper, I think to Jim Kickline, who wasn't yet the division director. I guess Lyle was the division director, but he was interacting with Arthur Burns, down to Burns' office. So my introduction, I think, to the division research statistics was helping people get information that help the decision makers deal with this particular crisis. And then in 1979, I started working on the Chrysler thing, not a financial crisis, but has some of the same types of approaches and learning that you do in dealing with these things. Hunt Brothers Silver in 1980. And working at that time with Fred Struble, who had moved over to supervision and regulation, and trying to figure out when Beige was going to collapse and what other broker dealers would collapse if the Hunt brothers couldn't pay their debt. Volcker, at that time we had the credit controls in, so the banks had to go to Volcker to get permission to make loans so the Hunt brothers could pay off some of the margin calls they were getting, and we didn't collapse a bunch of futures exchanges along with a bunch of broker dealers. In the early 1980s, my memory is that Jerry Corrigan was the assistant to Paul Volcker, and about every week I'd get a call from Jerry. This market is broken. This is horrible. Find out what's going on, Don. This time, this thing's really going to blow up. And so he was wrong about 90% of the time, but 10% of the time, it really did blow up. Continental Illinois in 1984, So Penn Square Bank in Continental Illinois, the stock market crash in '87, Greenspan's response to that, which was to recognize that there was a huge demand, there would be a huge demand for liquidity. The Federal Reserve had to promise to supply the liquidity, and then in the following months, we really monitored the demand for money and the demand for reserves and made sure that we were meeting that demand. The thrift industry meltdown through the '80s and into early '90s, constant source of problems. LTCM in 1999. There were a lot of issues in the international sphere, as Ted's sitting over there, Latin American debt crises, Asia, Russia, that Ted was dealing with, fortunately, but sometimes spilled back to the US, and that, for example, the Russian default spilled back into LTCM. And running the discount window really from the 1980s. I think when I started, the discount window was in supervision and regulation with a tie to Axelrod's office, but at some point it came over to Axelrod and then to monetary affairs, to running that. So a lot of these early problems related to the distortions from the run-up of inflation, people expecting it to continue, the Hunt brothers betting on it, for example, and then bringing it down, and particularly as that interacted with regulation Q deposit ceilings and the gradual relaxation of those ceilings. There was a bank, First Pennsylvania Bank, that was in the late 70s, early 80s, they collapsed. So the mistake they made was to hire a guy who'd been the head of research at the Philadelphia Fed, Bunting, I think his name was, and he knew how he was going to game this system, and he collapsed the bank. That's what happens when you put economists in charge of banks. With the regulation. And I've, like Mike, reflected a little bit on what do economists bring to crisis management and the lender of last resort. I think one thing we brought as RNS and MA economists is working at the intersection of finance and the real economy. So a different perspective, right? And seeing the feedbacks between what was happening in the real economy and what was happening in the finance markets, and then how the finance markets would feed back on the real economy. I mean, the macro financial side of RNS was mostly capital markets, and that's the mortgage stuff. I don't know what these sections are called anymore. Housing, mortgage, and consumer finance, whatever, were about helping the Stacy Tevlins of the day put the forecast together and seeing the relationship of finance and real economy. I think we lost some of that in the Great Moderation. So we went for too long without crises. All our models focused on interest rates, and that was the transmission to the economy. We weren't keeping track of quantities anymore, and we kind of thought, well, markets are more complete. The old-fashioned analysis of financial flows are unnecessary, and I think we got a lesson in all that around 2007, 2008. I think economists bring a sense of how markets work to crisis management, thinking about movements along a demand or supply curve or shifts of a demand or supply curve. External, think about the regulation piece of the response to crises. What are the externalities that regulation is dealing with? This sort of concepts, the concept of general equilibrium, the idea that you push on a place. Economists have this as part of their training and have this, and it's really important. And finally, that incentives matter. So people will look for ways to maximize rents and avoid regulation. And as you're designing your response to a crisis, either in the crisis or the regulatory response afterwards, you have to think very carefully about the incentives you're giving people and the effects of that. I think what's lacking often and gets remedied in a crisis may be a sense of how things work in the real world, the nitty-gritty institutional details, what are the exact terms of the contracts, what is material adverse change clause? When can that be triggered? When can it be triggered? How are these markets related to each other? What are the channels of contagions? How do participants see the risks and respond? How does this contribute to runs and fire sales? So all the frictions, the nitty-gritty details and the frictions all come out in the crises. And that's what we often don't pay enough attention to, I think, on a day-to-day basis. Designing those 13th Greece facilities in 2008, 2009, you guys needed to have very detailed knowledge of how securitization markets worked, how people would view a certain amount of leverage, et cetera. I reflect a little bit. I'm going to end with Chrysler, because in Paul Volcker's oral history, he says about Chrysler, I don't have the exact words here, but this is approximately correct. He says, I chose Don Kohn to work on Chrysler. I sort of thought Jim Kickline and Lyle Gramley had chosen me, but that's all right. I guess Lyle was in the council, so Jim Kickline had chosen me, but Paul took the credit. And then it says, he got an extracurricular education, square parentheses, laughter. So I'm still trying to figure out what laughter meant in that, in Volcker's thing, but I did get an extracurricular education about how markets work, how the auto industry was structured, how auto companies intersected with their suppliers, with local economies, with the unions. I watched Paul Volcker bargain with the UAW to get wages down. So I think that's what happens in a crisis. I think we economists get a little bit of an extracurricular education about how the world really works. And then hopefully we bring that back to our research when the crisis is over. Thank you.
Thanks, Don. Andreas?
That's a tough act to follow, Don. So you mentioned Jerry Corrigan, and maybe I'll start with Jerry Corrigan. So I joined RNS in 1998 when it was a stripling of 75 years of age, and I went to, I was working for Wayne Passmore in a newly created section called Financial Institutions, what we would now call non-bank financial institutions. It was very much ahead of its time. And we put a paper on the program at a conference at the San Francisco Fed. So in the fall of 1998, Wayne, Ed Etten, and I flew to San Francisco to participate in this conference, and the keynote speaker was Jerry Corrigan. So this was in the midst of the LTCM difficulties, and Corrigan, I think, threw away his prepared remarks and instead spoke to us on the topic of the difference between moral hazard and hazard. He's like, you economists always want to talk about moral hazard. I'm telling you, there's hazard. So, of course, LTCM turned out to be kind of a precursor of things to come, but at the time it felt, very unusual. Kind of the set of responses to all of that. I think I was, it felt a little disconnected. All happened sort of quickly and in the background. If you're a very junior staff economist, it's easy to not focus on it. So, I was working in the, as Don described, the kind of the back in those days, the fourth floor of the Eccles building, where the financial institution section was, which became the household and real estate finance section, which has since undergone further mitosis and evolution, I understand, into the real estate finance and consumer finance sections. And we were working on a broad set of consumer and household finance issues and commercial real estate. It was all fairly quiet for a long time. I went on sabbatical in 2006. I spent at the Urban Institute. I came back in the fall of 2006, really just as the Great Recession and the kind of financial crisis and all of that was beginning. And the kind of the early kind of shocks were very much, in the early days of all of that, we thought it had something to do with subprime mortgages. We were doing a lot of thinking about subprime mortgages at the time. And in December of 2006, a subprime mortgage lender, a non-bank called New Century failed as kind of a harbinger of things to come. You know, as the sort of financial markets started to get stressed out, you know, the terms and conditions to get a subprime loan started to get worse and worse, and we were hearing about, you know, subprime borrowers needing to roll over, refinance their loans. They were finding it harder to do so, and then, you know, the other kind of heterodox mortgages out there, Alt-A, jumbos, they also started to having to, you know, pay up in order to get a mortgage. And it started to feel like, you know, something broader was happening. And the way we were organized in those days, you know, there was sort of one person that covered credit cards, you know, student loans, auto loans. It's like Karen Pence, Shane Sherland, you know, me. And I would just sort of walk down the hallway, and it's almost like you could hear the phones ringing in everybody's office as each one of these markets became very stressed out and collapsed. And so, you know, the auto market, suddenly it was hard to get a car. And then it was, you know, the credit card companies started, you know, firing off distress flares. And then, you know, in 2007, the student loan market came under severe pressure. That's sort of this moment where, you know, you could tell kind of a macroeconomic story. Maybe there's weakness in the household sector that wasn't appreciated and people are having to pull back. But now, you know, student loans are government guaranteed. Like, what is the problem? Like, what is happening here? And it was around that time that I got to spend I'd spent many weekends working at the Fed, but it was my first time actually working like with colleagues on something that was going on. I got called down to Brian Madigan's office, you know, on like a Saturday or Sunday. Everybody's in shorts. Corey Stephenson is there, you know. Lots of people I didn't recognize. Who's this guy, Scott Alvarez, and, you know, why does he think he's so important? And we had a conference call with the regulator. I'll go easy on the details, I'm sure you can imagine, with the regulator of a regulator which is now defunct, of a company which is now defunct, basically asking for emergency liquidity support. And I had like no idea what really was going on, but they just kept asking me like, well, this entity has an enormous portfolio of subprime mortgages that we think are great. It also has a bunch of subprime mortgage-backed securities. We think those are wonderful. And it also holds a bunch of these super senior collateralized debt obligations, which are AAA. So how much do you think you'd be willing to lend against those? And, you know, nothing in my career to that point had prepared me to answer those sorts of questions. So I don't remember exactly what I said, but I think it was something along the lines of, I don't know, not much, let me get back to you. But that was really the beginning of, you know, the kind of the more active stage of the financial crisis, really, where this wasn't going to be contained in the U.S. household sector, that a bunch of financial institutions were going to be involved, a bunch of markets were going to collapse, and those of us who worked on this sorts of issues were going to be under, you know, increasing, we're going to have increasing demands on our time. So in, you know, in RNS, you know, our posture was very much, you know, we are absolutely going to sort of work all of this, you know, there's simply no question that this is the most important issue of the day, and we're going to, you know, work with, you know, BS&R, as it was known then, you know, the legal division, MA, of course, you know, everybody. We're, you know, we're very much kind of a service, you know, we're economists, we understand this market, we've written some papers on it, you know, we monitor, we published some statistics on this, but really, like as Don said, you know, as all of this went on, you know, the set of issues that we were being forced to address became more and more acute, and many of these details that really weren't in our papers up until that point started to become more and more salient. You know, so in 2008, you know, there were, I would say, already by late 2007 into 2008, there were a set of questions around what are we going to do with the underlying borrowers here? You know, they're going to need help. Mortgage markets for, you know, kind of non-conforming mortgages have closed down. You know, the administration had something that was known as the teaser freezer plan at the time, and so we had to sort of evaluate whether or not we thought this was a good idea or not. You know, but at a certain point, like when the TARP legislation passed, and there was suddenly this pot of fiscal money on the table. Some of it was going to be spent to support housing and mortgage borrowers. At that point, David Wilcox called me in and said, you now are the equity owner of the plan to buy junior liens, HELOCs, closed-end seconds, like go find whoever the guy is at Treasury who's working on this, it was Seth Wheeler, and go figure out how to do this. So that was, very much like suddenly we're sort of grappling with all these very complicated issues of how you stitch together securities that are out in the market, what prices you pay for them, there's really something about seeing a financial system under stress that really allows you to understand exactly how it works as a practical matter. Eventually, this morphed into a series of 13.3 facilities, many of which, touched on consumer and mortgage markets in different ways, most notably TALF, and the incredible work that Karen Pence and colleagues did on that. And then, ultimately the stress test, which was, truly a surreal experience, having come from like a very staid, quiet, kind of academic background, to just kind of wander into the office one day and find this stack of things that looked like diplomas, but they were my official commissions to examine 19 large bank holding companies. And we were sort of off to the races. Ultimately, a lot of that turned on how big the credit losses in the mortgage portfolio would be under the Dave Reifschneider, Nellie Lang developed stress scenario. Answering that question was, sort of, in some sense, you could work on a problem like that for your whole life and never be completely satisfied that you'd gotten the answer right. From another perspective, you've got until 6 o'clock tonight, and then you've got to explain like what the answer is. Just a couple of points to pick up from what Mike said. On the collaboration front, this really felt like all the walls between kind of different bureaucratic organizations at the Fed just completely dissolved. Reserve banks, BSNR, legal, we were all sort of working together, in a very, very collaborative way. It's something we've really tried to keep going with the Office of Financial Stability and now the Division of Financial Stability. That's very much in our mandate. Research throughout all of this, we learned a ton, and I think we were able to write a bunch of papers coming out of all of this experience that were very, very good. Chris Mayer, who was at the time at Columbia, came down to visit us in 2007 on a sabbatical. I said, the one thing is you got to write a paper with people here, and so that was the genesis of Chris's paper with Karen Pence and Shane Sherland, really one of the first really good papers on subprime mortgages. No doubt we'll have more to talk about on those fronts as well. But with that, I'll pass it over to Pat.
All right. I'll pick up, I think, on a few things that Mike and Don in particular said. I think I had a very unusual career for an economist at the Fed. First unusual that I moved around a whole lot. I started out in the IF division, where I think a very big influence on me is I started working for a colorful character named Alan Frankel, who Mike actually also worked for, as did Lou Alexander and Jeff Marquardt over the years. And I think Alan was always very well known for knowing the details of how the world works. Don mentioned that in a crisis, you can't have sort of a theoretical understanding of how things work, but you really need to know how the markets and institutions work. And Alan was always noted for that. And really the way he developed that knowledge was not by reading it in books, because most of the things that he was dealing with hadn't been written about yet, but he would get on a plane and go talk to bankers in New York or Chicago or San Francisco, and very much encouraged me to follow him in that path. So I would go out and talk to the bankers and write up what I learned. He always cautioned me that when talking to the bankers and writing it up, as he put it with his Bronx accent, you got to filter, by which he meant you had to critically evaluate what you were hearing from these characters and take into account that they would often be talking their book, to use another of his expressions. but that was a very valuable way to learn the details. Also, I think most of my career I dealt not with any of the top 10 things people would list as the things that R&S division actually works on, but on derivatives and clearing and settlement arrangements for financial instruments. And how did I get involved in that? Well, the first thing of any consequence I did at the board while I was in the international division was I was asked to evaluate these new proposals to trade contracts called Eurodollar futures. And I had been monitoring the Eurodollar markets for the IF division and had written my thesis on Treasury bill futures, so I was the natural candidate for that. So I read the various proposals, prepared a memo for the board summarizing the proposals, and back then, the board was before the CFTC, which regulates the futures markets, before it could list a futures contract, it was required to consult with the board and ask their advice. So I read the proposals, summarized them, and wrote a letter that said basically this would be a great idea. They got to try these things. Before going to the board, I took this to the I think it was called the supervision committee, whatever they called it back then. The names changed many times over the years. One of whose members was Lyle Gramley, the former R&S director. And Gramley said he didn't disagree with my analysis, and he was fine with me taking this to the board. But on the day of the board meeting, I should wear a red bandana because Volcker was going to slit my throat. And the reason for that was he absolutely hated futures, thought that they did nothing, they were just a negative influence because of largely, I think, his experience with the Hunt Brothers silver crisis that Don had talked about. But I persevered, no blood was shed, although the letter was rewritten to indicate that it would be a bad idea to allow the listing of these contracts, which later became the largest futures markets in the world, at least for a time, because the CFTC sensibly disregarded the board's fine advice. How did I get involved with derivatives? Well, maybe the first crisis, I think, where I had much direct experience, not so much with the crisis fighting as the crisis response, was the '87 stock market crash. And after the '87 stock market crash, the Reagan administration created this thing called the President's Working Group on Financial Markets, which was active from time to time through at least 2009, and I think still may exist, although it's been eclipsed by the FSOC, for better or worse. It was just bringing together the Treasury, Fed, CFTC, and SEC with occasional participation by the other banking regulators. And when the PWG looked at the stock market crash, one of the biggest concerns from a systemic risk perspective related to weaknesses in the clearing and settlement arrangements for stock index futures and options. In fact, in the wake of the stock market crash, there was an effort, I think, by the New York Financial Center to blame all these problems on things going on in Chicago. And in fact, there was a report, the Brady Commission report, that said just that. And the PWG was created to debunk the Brady Commission work, which became laden with irony when a couple years later, Dick Brady became the chairman of the PWG. But in any event, that got me involved in looking at these clearing and settlement arrangements, and that became something of a career, not just for the stock index futures, but for derivatives and securities generally. Later, I actually worked, I think, for 15 years, heading work by what's now called the CPMI, but used to be called the Committee on Payment and Settlement Systems, on first understanding risks in settlement arrangements, spurred in large measure by Jerry Corrigan, who was, I think, really the first person in the Federal Reserve System way back in 1988, gave a famous speech in Williamsburg where he really laid out, I think, at a very high level, an understanding of what systemic risk in payment and settlement systems was, how it arose, and how it might be mitigated. But we spent another 15 years elaborating on that and even producing the first international standards for securities and derivatives settlement systems. And, we're talking today mainly about crisis response, or narrowly, I would think, firefighting. I was much more involved always in figuring out after the crisis occurred and after it had been managed what regulatory changes had to take place to reduce the likelihood of future crises. I think looking back on it, we were much better at the firefighting aspects than at the mitigating the risk of future crises. Obviously, they continue to occur with no evidence of a decrease in severity or frequency. So at that point, how did I get involved in the crisis response in 2008? And the answer is, the other thing I worked on was 9/11, and on one particular aspect, which was that after the physical destruction on Wall Street, the Bank of New York took almost a week to get up back up in operation. And the Bank of New York was and still is basically the back office for Wall Street, so it brought Wall Street to a halt. In particular, it disrupted the so-called tri-party repo markets, which were the principal mechanisms then and now by which Wall Street finances itself. So I got involved in a long and not terribly successful project to strengthen the underpinnings of the tri-party repo market. But the important element of that was I and a bunch of mainly people at the New York Fed learned a heck of a lot about how all that actually worked. So when you get to 2008 and the Bear Stearns crisis, where Bear lost funding in the tri-party market, we were able to draw on that knowledge and on our contacts with people in the tri-party market and the clearing banks to quickly stand up the primary dealer credit facility. And then over the course of 2008, we expanded that and then expanded it very broadly on Lehman Weekend because of fear that basically the entire securities markets were going to melt down. And then when I came back from, actually I was one, I think Governor Warsh and I were the two people from the board that were at the New York Fed on Lehman Weekend. When I came back, I think it was Don that got me involved in real firefighting. I think at that point the Monetary Affairs Division, which really was the one that did most of the firefighting along with the New York Fed, was pretty much tapped out. Their bandwidth had been exhausted. And we were having this run on money market mutual funds. And it was time to develop a program to stem the run on money market mutual funds. In fact, I remember Don, I think it was Mark Vanderwide, and I began with just the two of us came to Don's office. And Don explained to us the governors had been thinking about this and had some plans. And it's always a mistake to let the governors discuss things without the staff present. So Mark and I had the sad task of informing them none of those things would work. And I think Don got a little bit grouchy and said, well, okay, right, but I don't want to see you again until you come back with a plan that will work. So we went back to our offices and came up with this incredible sort of Rube Goldberg thing where we would, because the money funds, interestingly, didn't have either, were unwilling or unable, had no legal authority to borrow from the Fed. After all, they're not supposed to be leveraged, including any leverage coming from the Fed. We had to figure out a way to get them money that didn't involve us directly lending to them. So we came up with this scheme to lend to the banks, mainly the custody banks, who in turn would buy the assets, the asset-backed commercial paper from the money funds, and that would meet their liquidity needs. In retrospect, ABCP was just, it was garbage, basically. So we had collateral, but it was not collateral that any sensible person would have wanted, but we had met the sort of technical, legal requirements for us to be able to launch this 13-3 program. All right, no, we'd have to ask. Mark might disagree with me, I don't know, he might not. But in any event, that got me involved in the liquidity facility, and really after that, I think I was involved in the early part of the TELF, and while Andreas and others were being stressed by the stress test, I was being stressed by going to work for Tim Geithner and Larry Summers to develop the regulatory response to the great financial crisis. And I don't know, I'm sure what you were doing was stressful, but working for Tim, more for Larry Summers was a new level of stress for me anyway.
Okay, well, thanks, everyone. That was very entertaining and very informative. I have a few questions to pose to the panel to continue the discussion, and then in a few minutes we'll take questions from the audience as well. So we've talked already about a number of the financial stress episodes that have happened that the Fed, RNS, and some of us have participated in. And I guess one question to dig into that a little bit more, and coming back to the focus of the conference, which is the RNS division, is that different financial stress events and different crises bring different parts of the Fed and different parts of RNS into the picture more. So for instance, the Andreas talked about how in the 2008 crisis, the financial sections, in particular the ones that were experts on mortgages, got deeply pulled into the crisis response. During the COVID pandemic, the non-financial side of RNS was critical to some of the work on the front lines there, reflecting all the impacts on the macroeconomy. So would anyone like to say a little bit more about your perspective on the different parts of RNS, more broadly, how economists can add value at times of financial stress? Where do you see the biggest value added, either from RNS or economic research in general? Don already talked a little bit about this. Not just financial crises, but broader financial stability type of work. Andreas, I see you unmuted your microphone, so you're welcome to go first.
Sorry. Look, it's interesting that the 2020 experience really was, it started very much kind of in the real side of the economy in a really unprecedented way. I'd like to highlight in particular this great memo, and it's now like a Fed's working paper has gone on to have, I think a wider life, and it's great to be able to talk about it out in public. That Ryan Decker, Robbie Kurtzman, Byron Lutzen, and Chris Nicarda did. They call the paper "Across the Universe." The memo had a more boring sort of subject line than that, but essentially, it's we had this question. We have to make sure that every employer out there has access to, some form of backstop credit, so that they're not going to close and destroy the kind of organizational capital that's associated with them purely because the financial system is having all of these difficulties. But we'd never really sort of sat down and thought about, where are all the jobs and who lends to those people with those jobs. So that's what the paper, the memo was about. And this thing really was the Rosetta Stone of the kind of the second phase of the pandemic response, behind the CARES Act and a lot of the Fed, 13.3 facilities that got set up with the Treasury back then. Really is, just a great piece of kind of like a very classic kind of RNS applied economic analysis, very sensible, bringing like excellent high quality data work to it, and then directly informative of the, the policy work that was sort of so urgent at the time.
Yeah. I can't really comment on RNS, pieces of RNS and recent crises, but I would like to come a little bit to the premise of your question. So I think there is an inherent procyclicality in the financial system. People get confident in good times, the profits are rolling, we don't really need to hold all this capital, all those assets we're holding don't have much risk, et cetera. And then in bad times, they overshoot on the other side. And I think the procyclicality of the financial system is what macro-prudential policy is supposed to counter. And I think we need to think more about that. At the Bank of England, when I was on the Financial Policy Committee there, we had a counter-cyclical capital buffer. I'm lobbying Mike now. A counter-cyclical capital buffer that went up in good times and was released several times in bad times, in COVID, but also Brexit times, that was supposed to counter the natural procyclicality, at least of the banking system. And I'm continue to be disappointed that the Fed hasn't adopted a more active use of the counter-cyclical capital buffer. We set it at 2 in normal times. We started at 1, and then the staff said, you start at 1, you're never going to have, think back to 2005, 2007, you would never build it up high enough to have something to release in bad times. The harder procyclicality issue is the non-financial, the market-based finance. And it's so hard to deal with because it's really about activities and markets. It's not about entities. It's about CFTC and SEC never agreeing on anything and getting coordination. But I really think research into this inherent procyclicality, which there's been a lot of, but then trying to come up with ideas about how to counter it is a really productive, would be a productive way to go.
Pat?
Well, I'm not going to give anybody advice on what they should do their research on. One thing that I think has been, it's a silver lining in all these crises and the fact that they seem to be occurring with greater frequency is it is bringing the people across the board together. And I'm glad to hear that I think both Andreas and Mike have saying that's true not only during the crisis, but it persists afterward. Because I think it was not at all, it was a weakness of the board when I first came here. The difficulties working across the silos, the lack of movement of people across the silos. I think someone probably has stats on this, but my impression was early days, people would get hired, say, by R&S by a certain section, and they'd spend their entire career in that section rather than moving much around, much less across divisions at the board. And the weakenings of those silos is a good thing because it's not just during crises, but it's in the policymaking process where collaboration is needed, and the more the better.
Okay, let me ask a question that's a little bit of a different sort of question than what we've been talking about because it's sort of more career focused. So the question is, so one feature of all of us on the panel is that we all started our career as research, moved into leadership positions at the Fed that are more, that have a much broader focus than just doing economic research. So my question is, how did your training and early career as research economist prepare you as you took on leadership roles?
I would say not very well. So for management and leadership, I mean, yeah. Okay. That's my answer. What do you guys think?
I'm not sure. Yeah, my graduate committee. I have a lot of. I think it had a lot of, strengths. Certainly, many Nobel Prizes among them. I'm not sure that I would trust them to lead like a Cub Scout troop out of a ditch. I think the Fed has an incredible culture of leadership training. I learned by the example set by Pat, Don, Mike, you, and others, more than the training that I got as an economist. And I mean, you could almost say that the Fed has figured out how to convert a PhD in economics into someone who has a PhD in economics, which I think under many circumstances would absolutely disqualify you for any form of leadership, into something that you might trust at least to get a Cub Scout troop out of a ditch.
I guess I first reiterate the distinction between management and leadership. I don't think it helped me all in management, and Mike's probably still sweeping up the broken glass from my 2 years as director of BSNR when it comes to management. In terms of leadership, I think it was helpful that a lot of the issues I worked on early in my career required me to work with people in other divisions, including legal and BSNR, with the New York Fed, and even with, for a real challenge, the CFTC and the SEC, where it's not an economist-dominated culture, but it's a lawyer-dominated culture. But I think that was useful, and when it came time, say, many of these cleanup exercises, I'm thinking mainly after Bear's failure, I think I got tasked with writing emails afterward, asking people across a whole bunch of divisions at the board to do a bunch of different things, and was used to being able to get things done where I had no ability to command and control. Those people didn't work for me, but I guess I had the chairman and Tim Geithner standing behind me, and so when I told them that here's the plan and here's what we needed you to do, it worked. But I think that was valuable. I don't know how, and obviously not everyone can have those experiences early in their career, but to the extent you do have an opportunity to get involved with either the FSOC or interagency banking regulatory work or international work. I think all of us have been involved to a greater or lesser degree in international work. That's helpful in terms of training you to work with people and to lead people who you don't necessarily they don't report to you. You can't give them a bad performance rating if they blow you off.
Okay, so, we've talked about the frequency and severity of financial crises don't seem to be changing much over time. But one thing that has changed here at the Fed is that our organizational structure has changed. And we can even look back to the creation of the Division of Monetary Affairs in 1987 and Division of Financial Stability in 2010 as examples. So how do you think about the role of R&S relating to monetary affairs, financial stability? We've also mentioned supervision and regulation, international finance. How have you managed the relations between the different parts of the Fed and thinking about lessons for the future? And we've already talked about this a little bit, but what are the challenges? What are the successes that we should keep in mind as we continue moving forward? We're all going to be all of us in this room are still working in the Fed and need to ensure that collaboration works going forward.
Well, let's see. From my monetary affairs perspective, I never had any trouble working with R&S. I thought we had a great collaboration on Blue Book. I guess it's Teal Book part something or other now, but Blue Book. Stuff. The R&S was running equations and models and telling me where I was wrong, which was frequent, and that was great. So I didn't feel like there might have been a couple months at which R&S and MA were feeling around the edges about where one left off and the other began. But after the first few months, I thought we had a very good collaborator. I didn't see that as a problem, and I think what we're hearing from the panel is that particularly when things go bad, everybody piles in. This is an organization of people who are drawn to it because they're drawn to public policy, the public interest. That's why we went into economics. We saw this was a discipline that had empirical aspect, that had a theoretical aspect, and you could put it all together, and if you did it right, and hopefully you could make people's lives better. That's why we're here, and when these crises hit, everybody piles in on that. You asked, I thought a little bit, you had a question about what lessons learned. I think one aspect that we don't talk about, and Andreas hit it a little bit, is the information flows. So one is the information coming in, particularly in a crisis, where everyone you talk to they're arguing their book, they have a point of view, they want the Fed to do something, they want you to take a view of their organization, help them out, lend them whatever, but filtering that information, trying to figure out what's really going on and what the dynamics are is really important. And working with S&R, as I said in the crisis, was absolutely essential about that. Bank ABC comes in and says, this is my position, and there was a supervisor you could talk to and say, well, this is what really is going on in Bank ABC. When you're making a discount window loan, you need to think about that. So that was really helpful. Everybody's pitching in. So the information, filtering the information coming in, but also what information goes out and how to explain things. And I think when I think about where I could have done a better job in a couple cases, one was LTCM. So things were going on. New York Fed was doing stuff. I was trying to keep Greenspan apprised of what was going on, but his mind was he was going to testify on Monday on something else, and he was trying to write that testimony. And I don't think I ever got through to him exactly what was going on. And then the other part of that was the rest of the board. So they read about LTCM in the newspapers. That was not what the head of monetary affairs should have allowed to happen. So I think communicating with the other policymakers, and then I want to make a broader communication point, and it's about lender of last resort. and what's a bailout and what isn't a bailout. And another regret I have is that I didn't try harder. I probably wouldn't have had any success to explain how what we did with our 13.3 facilities was a natural extension of why the Congress created the Federal Reserve, to fight these crises. It wasn't some unusual bailout thing. It was why you made us, in order to liquefy illiquid assets and to forestall or at least limit the run-fire sale dynamics. And somehow that message of discount window is an essential piece, is the most important macroprudential tool the Federal Reserve has, maybe. I mean, open market operations too, obviously. And it's not utilized enough. There's a stigma to it. The public doesn't understand it. I feel like we could have and should still do a better job of explaining what our role is in crises.
Okay, thanks, Don. Does anyone else want to come in on that?
I'd just like to reinforce that. I think it's not only our 13.3 facilities. I think we need to do a better job of explaining why we need standing facilities, including the discount window. There are people in Congress and elsewhere that think discount window loans are bailouts, and the discount window is not as effective as it might be, in part because of the stigma that creates. Also, I think because the Fed over its history has had certain ambivalence to whether it really believes the discount window is something that should be actively used. And it gets to the point where we found that certain very large banks, Silicon Valley and Signature, really weren't prepared to borrow at the discount window. And I think that's obviously something that's got to change. By the same token, the Fed created a standing repo facility, but it's a very narrow facility that I don't think really will meet the objectives of the people outside the Fed, at least, that have been arguing for a broad standing repo facility. And again, I think the message needs to get through that this is what a central bank exists for. And if these facilities aren't effective, you're going to have more severe disruptions. And in fact, you may have a need for the Fed to undertake even more intrusive interventions. I'm thinking of purchases of government securities rather than lending against government securities collateral. So that's very definitely something I think that more work needs to be done on.
You don't have to, but you're welcome.
Okay, so that was very interesting, those two interventions. I'm going to be much more focused on being just a Fed bureaucrat for a second. Pat said that when he was, an economist in RNS, the relationship with BS&R was not fantastic. I mean, I think that sort of chimes with my experience. This was in the run-up to the 2007 to 2009 crisis. I think in 2010, when we sat down and said, okay, let's take the best parts of what we've just been through in terms of the collaboration, and let's also think about how we might address some of the lack of collaboration that existed before then. We had a few sort of design principles. The Office of Financial Stability, as it was then, was sort of deliberately under-resourced so that we would never be a completely separate silo. We'd always have to rely on rotators to come in and work on stuff, on projects for the group. Everybody works on something that touches S&R, at least, as well as many other divisions. We're not going to build people need to be able. You need a kind of cultural exchange program, and people need to go spend time with folks that have a very, very different mandate and kind of style of working. We had, at the very beginning, when there were just 5 of us, one of them was a chief of staff, which was an officer-level position. It's something that we've maintained and continued, whose sole job it was is to inform people, to let people know what's going on, to coordinate, projects, and to do so at kind of a senior level. Kind of a final point, I think in part because, we are sort of deliberately under-resourced, and I think in part just because that's the nature of the world that we live in now. We do a lot of work with the reserve banks. The reserve banks, are like a real contributor and consumer of the financial stability process and work, and there's just a ton of insight and expertise, out among the reserve banks. The kind of hybrid working environment that we have now makes collaboration much easier. I think that's a real success story.
Okay, thanks. We have time for questions from the audience. So we've got folks with microphones. Just raise your hand. Ted, you want to go first?
Ted Truman, I apologize as an interloper. I am going to comment on that you had an offer to spend some time in IF, and then you would have 3 divisions too that you could be alumnus of. So you touched on some of this, and I have sort of two related questions in the crisis management stuff, and one is the challenge of recognizing a crisis in advance. My guess is that we never did very well in that stuff, but maybe things have improved. 9 of 10 crises don't happen, or something like that. And then the related question is, what do you do, or how do you advise the board, and what does the board do, and how do you, when you do see a crisis coming, right? But it's really not, at least the Federal Reserve's job, to cry fire prematurely, and how you advise, essentially, the board to manage the pre-crisis period, even when you think it's inevitable, that's what's going to happen. Thank you.
Well, the other thing I think is that you need to do as good a job as you can to strengthen the prudential regulatory environment, that requirements that apply. And again, coming back to the point that Don and you need to have the crisis management tools and make them usable, even if some doubt that see problems with that. Because I don't think we're ever going to foresee all the crises. And what I remember from the various crises is this fog of war phenomenon is always there. That it's very hard to get a clear view of what's happening in the early stages.
Yeah, I would say that my reaction to your question, Ted, is that we're never going to be able to predict crises almost by definition. Like if you were worried about something, then you're going to do something about it that would reduce the risk of a crisis. So it's more about strengthening the system in advance. It's about identifying vulnerabilities like the Financial Stability Report does, strengthening the infrastructure like Pat was talking about in terms of key markets. But I don't think we should say our goal is to predict crises, because then we're doomed to fail. Okay, another question. Karen.
Thank you. Just in the interest of kind of prepping for future crises, I just want to hear a little more. I just remember kind of the staff being just not ready. It's not like not ready in the sense of not understanding the substance, but just like not ready to deal with the stress and that kind of decision making. And I remember Pat Parkinson coming into a conference room at some point, I forget which challenge in the financial crisis we were supposed to be working on, but he's like, you just have to start throwing spaghetti at the wall and see what sticks. But just along those lines, I understand you can't predict the substance of the next crisis, but people do things like simulations just to get people's kind of just used to the idea that you might be under this kind of stress and you might have to step up and make a decision in a world that's just full of uncertainty. And I just was curious whether you make use of simulations or whether you think you might make use of simulations or what.
We do, Karen. We had kind of crisis management. I was like, well, 2020 was behind us. Let's try to build that crisis management muscle now and not sort of lose it. One thing that's just very, very hard is the requirement to make decisions under. So it's very hard. What it's like to have someone sort of say, like, what's this mortgage portfolio worth? Is it worth 60, 80? They say it's worth 95. How much are you willing to lend against it? I think we do a pretty good job as well as a job as can be done outside of kind of a live fire exercise. And I truly hope that we can spend the next 15 years doing nothing but getting good at that. That would be wonderful.
Okay, other questions?
Both Pat and Don talked about the virtue of strengthening the financial system, given that it's hard to predict the crises. It's good to strengthen it sometime when things are good, which sounds great to me. But it also is probably politically very unpopular. Large financial institutions have a lot of political power. They don't like to have capital surcharges added on when things are doing well, because that takes away from their profits. I know we are an apolitical organization. I swear we are. But still, there is that aspect of politics which one must confront when you think about what I think is the really good idea of our best defense, building up the strength of the financial system during good times. It's not going to be politically popular. How do we get around that?
The argument you just made is the one that I have gotten from the Fed in response to my capital buffer thing. What someone said, the D's won't like it when you lower it, and the R's won't like it when you raise it. I see all I can do is speak from my experience in the United Kingdom. And there was the banks were not terribly happy when the capital buffers were increased, but the Parliament seemed to understand. I mean, and they had they had a very bad crisis, as we did, a lot of unemployment, et cetera. And the idea of strengthening the banks extra in good times so you can release the capital and have them actually make loans, not get penalized for making those loans because of capital drop, seemed to resonate. I don't think we've even tried. So that was my response to the high-level person who gave me that DNR thing. I mean, try and explain it. It's so logical to me. It's hard not, yeah.
So first, as a senior fellow at the Bank Policy Institute, I have no idea what you're talking about. But I would say, building what Don said, the thing that worries me, I think the banking system is much stronger today. We can have a long debate about whether it needs to be strengthened further. The one thing that worries me is that an important objective of the post-crisis bank regulatory regime was to reduce procyclicality. And that was done by creating these capital conservation buffers that in principle could be drawn down in a crisis. I just don't think that's working very well. Now, whether the answer is to go to a countercyclical capital buffer, a different kind of buffer like that used in the UK, where it would be the regulators that would decide to use it as opposed to the banks, because it's very hard for the banks to use that buffer in a crisis. If everyone was using it, perhaps they could, but they don't want to stand out from the crowd. I think that issue of procyclicality is still ought to be on the to-do list for the banking regulators. And at that point, I'll stop giving advice on banking regulation.
I guess my answer would be more of a high-level answer, which would be to say that we at the Fed, research and statistics, but the Fed as a whole, we're a data-driven organization. We're based on what's the good analysis, what's the right analytical approach to answering the questions, and we have to put our best arguments forward. And I think we're good at doing that. That's sort of the benchmark of everything that we do at the Fed is data-driven and analytical, and I think we just need to keep playing to that. That's one of our strengths, and keep pushing in that direction would be my answer. Okay, so that's the end of the time we have today. Let me thank you to all the panelists. It's been a really interesting and entertaining discussion. Next on the agenda is lunch, which is right outside in the hallway.
Lunch is